Hello, everyone. My name is Craig Crow, and I am a field underwriter advisor and a financial coach. And this video was created to give you a better perspective and understanding of what life insurance is, and to show you the different advantages that come with these policies. But first, I wanted to clear the misunderstanding that I commonly hear when speaking to people. When I ask them, what do they know about life insurance? And they say, well, I know it's important to have because it pays for your funeral and you can leave money for your family. But sadly, that's all of the information that they know regarding life insurance. And because of this, some people don't see the value of purchasing a policy because sadly, it's not helping them now in their current situations. They only think that it would benefit their family after they pass away. So, I'm here to educate you on what else you can do with these policies and to show you how to protect your first name, meaning how you can use the living benefits and become your own bank with the cash value that builds up with certain policies, and how you can use those funds for a down payment on houses, vehicles, unexpected expenses that come up in life, or purchasing assets or investing into different vehicles. And I also want to show you how you can leave a legacy for your last name, meaning the knowledge that you will be able to pass down to future generations of how to obtain and sustain generational wealth and financial freedom. I want you to have the knowledge to have a more proactive mindset of how to protect your family by simply getting a policy, and how you can also truly become the lender and not the borrower. Because life insurance will not only benefit your family when you pass away, but I will be showing you how you can utilize a lot of these benefits while you are still alive. Part two of this video, I will be showing you the different illustrations of certain policies and how they work, by giving you examples of when a certain monthly premium is paid and how these policies can help you and your family to become your own bank and create generational financial freedom. This will consist of two examples, and they are how an index universal life and annuity policy can help fund your children's college education, retirement, and how your family can invest the tax-free loans that you can receive to purchase other assets or place them into other investment vehicles to create multiple streams of income and help diversify your family's financial portfolio. So stay plugged in for this exciting opportunity that you can take advantage of. The next portion of this video, I will be explaining and showing an illustration of how two specific policies work in your favor. They do require a longer investing period depending on your initial and continual premium payments made into them, but you will understand why these are two of my favorite policies that life insurance has to offer, because of the initial premiums paid into them and how the money that you invest into them over the years far outweighs the return of your initial investment into them. And I will explain how. In this picture, it is showing you how the caps and floors work with an IUL policy. It is showing you the percentages of returns from the S&P 500 throughout the years. As you can see, this picture is showing from 2003 all the way to 2022. In this column are the actual returns from the S&P 500, as you see the highs and also the lows that were received in 2008. And if you average all of these highs and lows, that's how they got the 7.54% return. Now, the two that we will pay attention to will be this S&P 500 with a 12% cap. So how the caps work, if you see the 2003 example, the return, if your money was fully invested into the stocks, you would have received a 17.32% return. But with an IUL, it is capped out at a 12%. Now, the value with an IUL, like I stated, you won't lose any of the money that is in your policy. So if you see in 2008 how it was a negative return and the money in your policy was compounded still at this 0.25%. So this is what you call the floor. So your money will never decrease below this because of the compound interest that is accrued with this policy. And as you see, throughout the years, it was an 8.08% return for the S&P 500 with a 12% cap. And the other index that we will pay attention to will be the Barclays index. And as you see, throughout the years, it was a 9.48% return. So these are the two values that we will pay attention to for this particular illustration. But this is just showing you the added bonus of the caps and floors that come with an IUL policy to protect the value of your money. Because as you see, the 7.54% return versus the 8.08% return and the 9.48% return. So in this picture, I will be showing you what an index universal life or IUL policy will look like for a 1-year-old male. Now you start off with a death benefit or face amount of $240,368. Now, the initial premium payment or monthly payment that you will have to make will be $150 per month. Now, this IUL policy comes with additional riders to protect your health, such as a critical illness rider, terminal illness rider, and chronic illness rider. Now, although you do have to pay $150 for this illustration that I will be showing you to be accurate, if you ever fall on hard times, all you have to do is pay this $35.25 to keep the policy from lapsing and to stay active. Now, whenever you get the necessary funds to pay back on the payments that you've missed, all you would have to do is pay the difference between this amount and this amount for the illustration that will be shown to you to be displayed accurately. This is an IUL illustration for a 1-year-old male, and the face amount or death benefit that you start off with will be $240,368. The first column I want you to pay attention to will be the age. This is how old your son will be throughout the life of the policy. The column marked years is showing the years that the policy has been enforced. And where you see planned premium outlay, this is showing you your yearly payments going into this policy. So that's $150 times 12, giving you a value of $1,800. Now the next column, labeled withdrawals and loans, these are the tax-free payouts that you will receive to become your own bank. And in this example, it will be to fund your children's college education and your retirement. And this column right here is showing you that you will receive a 6.54% of compound interest on your policy per year. The net death benefit is showing how much your beneficiary will receive whenever your children or your son unfortunately passes away. And as you see, it's already increased from this $240,368 to $241,368. $748. So as you see, the net death benefit will increase per year for every monthly payment or yearly payment in this case that goes into it. If you take a look at age 11, year 10 of the policy, you have paid a total of $18,000. Now, if you go down to age 21, year 20 of the policy, you have paid a total of $36,000, but you have already started receiving the tax-free payouts to help fund their college education. And starting at age 19, year 18 of the policy, you have received $11,705. Now, although you have not received all of your payments to help fund their college education, if you include the following 2 years, you have received a total of $58,525. So already at year 30 of the policy, age 31, you have paid a total of $54,000 and you've already got paid out $58,525. So you have already received more with this policy than what you have actually paid into it. And as you see, at age 19, year 18 of the policy, the payments that were taken out for tax-free loans has decreased your net death benefit. And this is where the funds are coming out and giving you the tax-free loans that are allowing you to become your own bank. So this is the added value of an IUL policy because you still receive a death benefit even if something happens to your child while receiving tax-free payouts to help supplement their college education or for you to do it however you see fit. Now, with an IUL, it is recommended to pay into this for at least 10 to 20 years, depending on how much you are actually able to put into it. This is because you can maximize how much of a death benefit and how much of a cash value buildup that you are able to receive throughout the continual payments being made into this policy. With this particular example, I have this illustration being paid into until age 65, year 64 of the policy. And as you see, no more payments are being made into this policy. So you have paid a total of $115,200. And as you see, at age 66, year 65 of the policy, you have already started receiving your supplemental funds for your retirement, giving you a value each year of $79,978 of tax-free loan money. And as you see, if you include this year plus the other 5 years that your child already received funds for their college education, you have received more out of this policy than what you actually put into it. And if your son were to live until age 90, they would have already received $2,057,967. Now, if they unfortunately pass away at age 91, year 90 of the policy, although they have already received all of these funds, by only putting in this much, you are still being able to leave their family with $411,424 of a death benefit. Now, this is the added bonus of having an IUL policy because it is not only protecting your life, your health, but building your wealth all at the same time and allowing you to take advantage of the compound interest that comes with the market and allowing you to become your bank at a faster rate. Now, with the next example, I will show you different methods that you can utilize to create other streams of passive income and being able to purchase more assets and also how you can use an annuity to boost how much you can receive during your retirement years, and being able to leave more money for your family. So, the next portion of this video will show you my other favorite policy of life insurance and the different options available for you to invest in so that you can diversify your portfolio and create multiple streams of income, all with the tax-free money that you will receive from your IUL policy, such as multifamily homes, investment vehicles, high yield savings accounts, and annuities. So let's say, for instance, that your child didn't want to go to college, or they received a scholarship and didn't have to pay out of pocket for school. These funds will still be available to you. But let's say they wanted to diversify and split these funds up into different investment vehicles. This will help your child to be able to create more passive streams of income, because it is always best to diversify your money to see which product works best for you. For this example, let's say that we use these 3 years to invest into an annuity to help boost how much your child will be able to receive for their retirement years. Then, let's say that we use these 2 years of income to invest in real estate or other investment vehicles. And let's see how that scenario will work out for them. So let's say that your child used those 2 years worth of tax-free loan payments that they received from the IUL that was scheduled to pay out for their college education with a total value of about $20,000. One of the best investments that you can have is real estate, because there are always people that need somewhere to stay. And if you invest in a multi-family home instead of a single family home, there is a bigger bonus, because you can use this as a rental property while your child is living there. And after they move out, after a certain amount of years, depending on the lender and the type of loan that they receive, since your child would be considered a first-time homeowner, they can have multiple streams of passive income depending on the type of multifamily home that they purchase, with the other tenants that are living there helping your child pay off the loan that they received from purchasing the multifamily home. I would recommend, after making the down payment on the multifamily home, to set aside some extra funds for just in case money. And whatever is left over, put those funds into a different investment vehicle or find a high yield account to allow their money to grow at a faster rate. But for now, let's focus on the multifamily home. One of the main benefits of a multifamily home is that it's usually more affordable than a single family home. And with the current real estate market as it is more difficult for people to buy a home, and this is true especially for first-time home buyers. Multifamily properties are considered a relatively safe investment compared to other real estate asset classes. That's because even during an economic downturn or recession, people need somewhere to live. In fact, during a recession, many people find themselves forced to sell their homes and move into a rental housing unit instead. This is a great asset to have, because it is not only building your wealth with passive streams of income, but giving them a place to live as well. So these are other options that you can use your tax-free money on that you will receive from your IUL policy. You can make investments into these types of vehicles to receive a bigger return on your initial investment. Some other investment vehicles are real estate, stocks, bonds, or mutual funds, as you see on the picture labeled investment vehicles. Now, with high yield savings accounts, these accounts are offered by banks and financial institutions that provide higher interest rates than traditional savings accounts, so you can get a bigger return on the value of the money that you put into these types of vehicles. Always try to find the account that pays you the highest amount of compound interest on the money that will be in your account. So, the definition of an annuity is a contract in which an insurance company makes a series of income payments at regular intervals in return for a premium or multiple premiums you have paid. Annuities are most often bought for future retirement income and can be paid to you as an income that will be guaranteed to last as long as you live. Annuities can be great investment vehicles because it gives you a much higher interest rate of return than what you would receive from the IUL, but it still gives you the protection that you desire with a 0% floor, so you would never receive a negative return on the money in your policy. The only catch is that you must have a larger initial premium payment to be able to have a policy such as this. For this example, you need at least a $10,000 initial premium to get this policy started. These policies can be funded by your 401k, money you have in the bank, or any other assets or investment vehicles that can be liquidated to fund this account. So this is a great policy to have, and you will see the advantages that you can receive in the example I will be showing you. This is an example of what an illustration of an annuity will look like for a 23-year-old male. Now, this is a hypothetical illustration because of the interest rates that are credited to this account are from previous years, and because of how the market is always fluctuating, it does have a tendency to repeat itself with the ups and downs. So you may get the same results or even better. This is showing the $30,000 that we took from the IUL payout that your child received for their college education fund. And that $30,000 was made to make their initial premium payment for this policy to get started. I want you to pay attention to the contract years, which states how long the policy has been enforced. The age is showing how old your child will be throughout the life of the policy. The $30,000, where it says premium, is the one time initial premium that was paid into this to get the policy started. The annual withdrawals are the money that you will receive during the course of this policy. The account value interest crediting rate is the interest that the money in your policy will be compounded by for those particular years, and the death benefit is what your child's family will receive whenever they pass away. This is where the funds will be coming out to be able to supplement their income for their retirement years. And this is how you will become your own bank by leveraging the money in your policy to utilize things that you desire. This illustration is a 10-year annuity. As you can see, throughout the years, the account value, the surrender value, and the death benefit all start matching up after year 10. The interest rate that you see the money in your policy is being compounded by are actual returns from previous years to give you a better estimate of what your policy will look like. Now, although you only started with a $30,000 investment, if you look at year 25 of the contract, that $30,000 has turned to $682,569. This is the added bonus of having an annuity because of the higher rate of return with the money in your account and the higher interest rates being credited to the funds in your policy. In this annuity illustration, Although I have the payments structured to come out at age 66, you technically can start receiving the retirement fund payments as early as age 60 without being penalized for early withdrawal fees. And because most people tend to retire at age 65, that is why this illustration is being shown this way. But just like the IUL, you decide how much you want your premium payments to be and how long you want to pay into these policies. Also, when you want to schedule payments to be made to you. So it's very versatile to fit your specific needs and budget. Now, the initial payment that came from your child's IUL policy of $30,000 at age 65 has now grown to $6,545,073. These payments are being made to you at a 10% rate of what the total account value of what the annuity is worth at each particular year. Now, just to remind you, this annuity is being credited each year by these interest rates, and that is where you see the value of the funds in your policy will continue to grow even after the funds have been taken out each year. And as you see, at age 73, you have got paid a total of $4,922,512, all from that initial $30,000 premium payment that was made to start funding this annuity. And even if your child were to unfortunately pass away, they still have over a $5 million death benefit that they are able to leave for their family. Now, with an IUL policy, the funds that you receive to become your own bank are given to you tax-free. But with an annuity, all of the withdrawals and payments that you receive are subject to federal and state taxes, depending on what your tax bracket is. But still, at age 83, you have got paid a total of $11,961,614 after taxes are paid on this amount throughout the years. And you still have a $7 million death benefit to leave to your family. Now, like the example we had with the IUL that gave you a total payout of over $2 million at age 90, at age 91, with this annuity, you would have received over $18 million and still have a death benefit to leave to your family of over $9 million. So this is the added bonus of having an annuity because of the rapid growth with the compound interest each year. With this type of policy, it is one of the best retirement plans to have to secure your wealth and a legacy of financial freedom. Now, securing your family's financial freedom starts with you. But it's important to have a plan in place of how to achieve this and a general idea of how there are products available to protect the continual growth and security to keep the funds and assets in your family that will let you continue a legacy of financial independence. And I will explain to you how this works. As you see in the picture, imagine you are at the top and you start with a $150,000 policy. You teach your kids the importance of receiving a policy, and when they get older, they will be able to double what you left for them. And they will be able to leave their children with $300,000. And the next generation will be able to leave their children with $600,000. And then the following generation will have $1.2 million to be able to pass down to continue to create generational wealth. Now, it is very important to put these policies in a trust to not only ensure that the money will be dispersed properly, but also to protect your assets. And this will continue to stay within the family to continue the legacy of creating generational wealth. One well known family that has taken advantage of this example of passing down generational wealth is the Rockefeller family. Another example I like to use is my grandmother, who is 91 years old and blessed to have seen three, going on four generations of the family her and my grandfather created. So, just imagine my grandfather and my grandmother at the top of this picture, just like you can be, with the commitment of protecting your family by just getting a policy. If she had the knowledge, just like some of you do now, you have a little knowledge about what life insurance is and what it can do, and other investment opportunities, she would have been able to see the effects of her sacrifices made with her family and giving them the financial freedom, just like you can do with your family right now. Don't let the lack of money you may have now discourage you from protecting your family and putting a policy in place today. Because the longer you wait, and we all know time waits for no one. So each day that goes by is essential to allow the compound interest to let your money grow for you. And you are also taking a risk in delaying receiving coverage because, like I stated before, life insurance is based on your age and your health. So the older you get, the higher your premium payment will be for the higher amount of coverage to protect your family, and risking that your health could change at any given moment and therefore limit you on the possible policies you have the opportunity to receive now before these factors affect the outcome of what you want to achieve for your family. Because as I have shown you, although you are spending money to receive these policies to protect your life, you are actually building your chances to have financial freedom as well. Always remember that having something in place is better than having nothing at all when the time comes when your family will really need it. And just because you may not be able to afford some of the examples that I have shown you throughout this video, or even if you desire to put something in place that's even more, just start where you can and build from there. Remember, money is nothing but a tool. And once you learn how to use this tool in your favor, the sky is the limit. So don't work so hard for your money. Let your money work hard for you, which is very possible, as you have seen with the examples I have shown you. Like I stated previously, it is very important once you reach the point of obtaining a lot of wealth and assets that you have acquired throughout your lifetime. It is very important to place those items within a trust to protect what you have created. There are many different types of trust available to fit your specific needs, but here are the four main types of trust that I will cover: a living, revocable, irrevocable, and testamentary types of trust. And here is a breakdown of what a trust can do to protect your assets that you have acquired throughout your lifetime. They can avoid probate, protect your assets, and help with your family wealth planning as well. This is one of the methods that I spoke about previously that a well known family has done to pass down a legacy of generational wealth, and that would be the Rockefeller family. So there are many different ways to obtain the wealth that you desire as well as the financial freedom. But one way I have shown you is through life insurance. Because with this, you're not only protecting your life from unexpected and natural causes of death, but your health with critical, chronic, and terminal illness protection, but also building your wealth all at the same time. So that is the importance of what life insurance can do for you and how you can utilize these types of policies to become your own bank. Now, read the book, What Would the Rockefellers Do? To see how they created generational wealth and for a better understanding of how to become your own bank. I would recommend reading IUL ASAP. Now, to help expand your financial literacy and help start changing your mindset of acquiring more assets, I would recommend reading Rich Dad, Poor Dad. And lastly, to help you think more like an investor or a business owner, plus learn about the different tax exemptions you can receive, I recommend you read Cash Flow Quadrant. Remember, knowledge is power. Never stop learning. So, for more illustrations and more updated information, you can follow me on any of these social media platforms, and the information to find them are displayed on the screen. You can follow me and like the content of the videos that you feel were beneficial to you. And if you feel like your family, friends, or anyone that you meet would benefit from this, please don't hesitate to share. I hope this has helped expand your knowledge on financial literacy, and hopefully you have learned something new about how to protect your family and create generational wealth and health through life insurance. I pray you all have a blessed and prosperous day, and thank you for taking the time to educate yourself. And always remember that knowledge is power. So never stop trying to learn something new every single day to enhance your wisdom. Until next time, see you later. At the top right of this flyer is my name, my contact information, and the company's website for you to check out everything regarding different policies and to get a better understanding of the company itself. The scheduling information is to schedule a meeting with me so that we can customize your portfolio and to start protecting your life's journey by creating generational wealth, or I can help by answering any questions you have. Just simply enter the scheduling information link into your web browser. This will bring you to a Calendly website that will allow you to pick any date and time to schedule a meeting with me. As you can see, life insurance is not just death benefits, it provides living benefits as well. It also provides coverage for three categories of life's journey, such as your life, health, and wealth. So contact me if any specific policy sticks out to you. We can discuss it in more detail and customize your portfolio to fit your specific needs and budget.